want to first welcome everyone and thank everyone for coming out tonight, and especially our panelists. We have a really extraordinary group here to discuss with us both the substance of the presidential candidate tax plans and also their effects and how they're modeled. And these models, which both Tax Foundation and the Tax Policy Center have microsimulation models, have a real impact on elections. So we'll probably get into this a bit, but they're fundamentally in some ways about fact-checking presidential tax proposals and candidates' claims about them. And they're a way for voters to understand what are the revenue impacts of proposals, who's going to benefit or bear the burdens from those proposals. And while government agencies like JCT or CBO or the Treasury Department often do this for legislative proposals, they as a rule don't do this for campaign proposals, which is what makes the role of folks from the organizations that we have here tonight even more important in the context of a presidential campaign to really help inform voters about the proposals. So their role is really to play an honest broker, explain what the candidates are proposing, and we'll talk a little bit about that can at times be confusing, and also what the impacts would be and try to translate that so that people can understand, both what would be the impacts on the economy and what would be the impacts for people personally from candidates' proposals. There has also been a bit of a sea change since the last presidential campaign, with something that is probably old hat for some people in the room and new hat for others, called dynamic scoring. And that's become a lot more common. And this is basically the idea that generally when the effects of a tax proposal are estimated, most estimators will include microeconomic effects. So they'll look at if this is gonna, if you have a tax subsidy for charity or education, whether it'll change how much people spend on those goods. But they hold constant GDP, so they assume there's no impact on growth. And macro economic analysis, or what I'll call macro dynamic scoring, is when you allow a candidate or any tax plan to also impact GDP and then estimate what that GDP impact is and what the revenue effects would be from it. And so the Tax Foundation and Tax Policy Center have done those macro dynamic estimates for both the Clinton and Trump tax plans this year. And this is relatively new, and they're really on the cutting edge. And so I think one of the many things we can talk about tonight is how those models are developing, where they're similar and different, and what some of the assumptions are. So our plan today, if we have a clicker, is we are first going to walk through fairly quickly a summary of each of the candidates' tax plans. Then Kyle's going to talk about the model estimates from the Tax Foundation. Ben's going to talk about the Tax Policy Centers. And Chai-Ching is going to discuss the importance of these models and also some of the differences. And then we'll hopefully have plenty of time for Q&A. So without further ado, I want to introduce our panelists. So our first panelist is Kyle Pomerleau. He's the Director of Federal Projects at the Tax Foundation, and he leads their tax modeling team and oversees their research. He, of course, researches and writes on a variety of tax issues. He holds a BA from the University of Southern Maine and an MPP from the McCourt School of Public Policy at Georgetown. Ben Page, in the middle, is a Senior Fellow at the Urban Brookings Tax Policy Center, and he leads their efforts to estimate the macroeconomic effects of tax policy and incorporate these effects into analyses of tax proposals. And before joining Urban, he worked at the Congressional Budget Office, where he also worked a lot on dynamic analysis, which is the Congressional Budget Office and the Joint Committee on Taxation have been really beefing up their capabilities in this area as well. And he has an AB in economics from Stanford and a PhD in economics from MIT. And then furthest to my left is Chai-Ching Wang, who's a senior tax policy analyst at the Center on Budget and Policy Priorities, where she, of course, focuses on fiscal and economic effects of tax policy too. She's previously served as an academic, teaching and researching in tax law at the University of Auckland. She also worked on economic policy issues for the New Zealand Institute and practiced as a tax solicitor. And she has a bachelor's from the University of Auckland and an LLM from Columbia, but we still think very highly of her despite that. So without further ado, I will turn it over to Kyle. And once again, thank you all three for making the trip up here to educate all of us today.
Thank you. So I get the great task of talking about or just introducing the details of the Trump tax plan. So the Trump tax plan actually is a long story, but I'll just go with what we understand the plan is today, because he introduced a plan originally in September of 2015, but since then he's changed it a couple times, but these are the details as of today, maybe. So on the individual side, he consolidates the current 7 tax brackets that have a top rate up to 39.6, changes them to 3 brackets, 12%, 25%, and 33%. Brackets themselves are also a lot more condensed, so the top bracket actually applies at around $125,000 of taxable income. He eliminates the head of household filing status and the personal exemption, but expands the standard deduction to $15,000, $30,000 married filing jointly. At the same time, he puts a cap on itemized deductions at a total value of $100,000. So individuals can only deduct up to $100,000 in itemized deductions, $200,000 married filing jointly. So he's sort of going after itemized deductions both from the bottom and from the top. He eliminates the net investment income tax, which is a 3.8% tax on investment income introduced as part of the ACA. He also eliminates or taxes carried interest as ordinary income. And he eliminates the alternative minimum tax. On the business side, he reduces the corporate tax rate from 35% all the way down to 15% while eliminating the corporate alternative minimum tax. He allows firms engaged in manufacturing to choose between the full expensing of capital investment and a deduction for net interest expense. Now, just a couple words on full expensing if people aren't familiar with that. So under current law, corporations, when calculating their taxable income, usually are able to deduct their expenses, state and local taxes, the inputs that they put into the production process, except for capital investments. Capital investments being like machines, factories, those instead are depreciated over time. So if you buy a $100 machine, it has to be depreciated over 3 years. You only get a $33 deduction each year until that expires. Under full expensing, you're allowed to deduct the full cost of a capital investment immediately. Now, the elimination of the net interest expense usually is paired with that because it's consistent with what you would do under a value-added tax. So he's basically allowing manufacturers to choose between the corporate income tax and a variation of a value-added tax. He also, on the business side, eliminates all business credits except for the foreign tax credit in the research and development credit. He also enacts what's called a deemed repatriation of 10%. So under current law, corporations that do business overseas have to pay tax on their worldwide profits. The profits they earn, say, in the United Kingdom are taxed first in the United Kingdom, and then if they're brought back to the United States, face an additional tax of up to 35% in order to make sure that the additional tax is only that, say, difference of 15%. You get the foreign tax credit for what you've already paid in the United Kingdom. So he keeps the deemed repatriation, of course, is a tax on the profits that have built up overseas but have yet to come back to the United States. So under right now, I think JCT estimates about $2.6 trillion of profits that are being held overseas that are either in cash for the most part, if you're, say, in the tech or pharmaceutical industries, but say are invested in or also invested in actual capital investments, say if you're the oil and natural gas industry. It's just a flat 10% tax on all those assets or profits. He also eliminates the estate tax, but disallows step-up in basis for estates of over $10 million. to make sure that at least some assets here are taxed, especially the capital gains. The last piece, of course, is a big question mark, is what's he doing with pass-through business income? So just a little background, pass-through businesses. It's in the United States, there are two types of businesses, traditional C corporations and pass-through businesses. Traditional C corporations pay the corporate rate, but then they can retain earnings or distribute those earnings to their shareholders. The shareholders then pay tax on that profit. Pass-through businesses, on the other hand, are businesses such as LLCs, sole proprietorships. They don't really have an entity-level tax. When they earn profits, those profits are immediately distributed to their owners. Those owners then pay ordinary rates on those profits. Now, originally Trump in 2015 said, I'm going to tax that business income, that pass-through income, at a 15% rate. So he's going to sort of create this bifurcated system between ordinary income and business income. However, when he introduced his plan in September of 2016, he originally said that, or the release that was on the website said that he was no longer going to do that. He was going to tax it at ordinary income, or at least I think it was just omitted from the proposal. Of course, a lot of people that pay attention to this stuff called up the campaign and asked, hey, what are you doing? The campaign gave conflicting answers, some saying, oh, we're going to give the low rate, some saying, oh, no, we're not going to give the lower rate. And then after maybe a couple days of constant questions from press, policy people, they came out with another statement that was neither a special rate nor a taxing at ordinary income. Instead, he's come up with this proposal, we think, where pass-through businesses, when they earn their profits, in order to get this special rate, need to be kind of treated like a corporation, where they earn their profits, they have to retain their earnings in order to get the 15% rate. And then when they distribute those earnings, they pay the dividend tax, or at least we think that that's the interpretation. I think that's the interpretation TPC went with when they modeled it. But in my opinion, this issue is still not decided. I still think that there are a lot of holes in the proposal, whether he goes for the special rate or the retained earnings approach, but that's a big question mark. So when we start talking about how this plan would actually affect revenues, keep in mind that we don't actually know because the plan hasn't been figured out yet.
Great. And Kyle is minimizing his role, I think, a little bit in this. So when this all happened, and please correct me if I had this wrong, the Trump campaign had shared some of the details of the new plan in advance so that the tax foundation could estimate it, and then sort of on the same day started telling some other groups that this pass-through rate was still going to apply, the special 15% rate. So Kyle and his colleagues were sort of caught in a media maelstrom, or does it or doesn't it apply, and put out a really helpful document explaining why this was confusing, and as we'll get to, estimated it each way so that people could see what the effects were depending on which version of the plan one believed was the underlying truth. So, so with that, I'll turn it over to Ben to do a quick summary of the Clinton plan.
So the Clinton plan also has been through some evolution, but in the same way, I'm just going to concentrate on what the plan is now. It was very important to those of us who were trying to estimate these plans that they kept changing, but probably doesn't matter as much to you. So I'll just talk about the plan as it is now, or as we understand it now. This Clinton tax plan, I mean, really shows up kind of the stark difference between these two candidates. So in a lot of ways, it's the mirror image of the Trump plan, maybe a smaller mirror image. The Trump plan is a very large, huge, you might say, tax cut, kind of historically large. And the Clinton plan is a tax increase that would look very significant in historical context if it weren't being compared to the Trump plan. And the Trump plan tends to cut taxes on capital income that tends to be received by high-income households, cuts top rates a lot. So going in, you can kind of tell that a lot of the benefits of the Trump plan are going to flow to high-income households. The Clinton plan, totally the opposite. Many of its provisions are explicitly targeted towards high-income households. and it raises taxes on capital income. So you can kind of tell going in that a lot of it, the burden is going to fall on higher income households in this plan. Okay, and I guess, yeah, I could save the last point for later. So the Clinton plan includes three main tax increases on ordinary income. First, it would limit the tax value of deductions to 28%. So the idea there is that usually the value of a deduction is your marginal tax rate. So if you're in the 33% tax bracket and you get a dollar of deductions, that's worth 33 cents in saved taxes. The Clinton plan would limit that to 28 cents no matter what your marginal tax rate was. So that by definition only falls on people above the 28% tax bracket. It would include a 4% surcharge on income over $5 million. That's for joint filers. And it would also include a new minimum tax of 30% of AGI on income starting to be phased in at $1 million and fully phased in by $2 million. And this is sometimes referred to as the Buffett rule. The idea of this was Warren Buffett's complaint was that he had a lower tax rate than his secretary, and this would ensure that the boss would have at least as high a tax rate as the secretary, in theory at least. The plan would raise capital gains taxes in three ways. First of all, it would raise capital gains taxes on capital gains that are held between 1 and 6 years. So right now there's just two capital gains tax rates, one for short-term holdings of up to a year and one for long-term holdings. And she would add a number of graduated taxes depending on how long the assets had been held. The idea of this to encourage holding kind of people to think in terms of the long run when they're investing. That's the stated. It would also make the tax system more complicated. So it would definitely, for people selling assets, it would be a lot harder to figure out what you owe. Her plan would limit like-kind exchanges. So there's a way that you can avoid that some transactions can avoid paying capital gains if you sell an asset that's appreciated in value, but then you buy a similar asset. In some cases, this is that capital gains is not taxed, and the Clinton plan would limit the ability to do that. And finally, the plan would limit the step-up in basis at death of capital gains. So a lot of capital gains are not taxed because if the owner dies, then the person who receives it gets to revalue it at the current value that what was gained during the lifetime of the holder is never taxed. And this plan would limit the people's ability to do that. So this is kind of on the edge between it's not clear whether to call that a change in capital gains taxes or a change in estate taxes. It only applies to the estate. Essentially, it's kind of an extra tax. The plan would also explicitly raise estate and gift taxes, both by lowering the amount above which an estate is taxable and by raising the tax rates and making them graduated, rise with higher estates. It would limit corporate tax avoidance. These are kind of smaller provisions, but it would attempts to limit corporate tax avoidance through international transactions. So it limits the ability of companies to merge with a smaller company overseas and then say, oh, now we're a foreign company to escape U.S. taxation. It limits the ability of domestic companies to pay interest payments, interest payments to a foreign parent company to lower their U.S. tax liability to create a deductible expense. And it would include an exit tax on inversions on companies that reincorporated in overseas. The untaxed earnings in their subsidiaries would be subject to tax on that. And then there are a few, those are all revenue-raising provisions. There are a few revenue-reducing provisions. The plan would raise the child tax credit from $1,000 to $2,000, and it would also repeal the Cadillac tax on high-cost health plans. And that's actually something that's not a huge deal in the first 10 years, but that's a tax that, because it depends on the value of health insurance, and we think health costs rise over time, kind of over the second 10 years and out, that's actually a big revenue loser. And there are some targeted tax breaks for small businesses.
Great. Well, thanks for those very efficient summaries of a lot of detail. So now maybe we'll turn to looking at what the models tell us about the effects of the attack.
Yes. All right. So I guess before jumping into the results, it might be useful to give you maybe what I'd call the brief explanation of how our model works, or how our model looks at the world. So the Tax Foundation, we have a macroeconomic model. It's also a tax model. The underlying feature, or underlying sort of the core of the model, is what's called the Cobb-Douglas production function. Basically says that the amount of economic output in the U.S. economy is a function of how much capital and how much labor. These inputs, or the level of these inputs, are determined by essentially marginal tax rates. So what's the tax on the next dollar of economic activity, whether that's investment or work. So for labor, it's pretty easy. It's the marginal tax rate. It ends up being the weighted average marginal tax rate on individuals. There are a few adjustments in there. And then for capital, it ends up being something called the service price of capital. That it basically says that an investment has to have a pre-tax return high enough to satisfy investors after accounting for all levels of taxes that they may hit. So if you as an individual require, say, a 3.5% return to make it worthwhile for you to invest, delay your consumption, that means an investment needs to have some return before tax to get to that rate of return after tax. So if you drop the tax rate on capital investment, overall that pre-tax rate of return can decline. That means that marginal investments that are not worthwhile under current law become worthwhile. All right. So we'll start, also two other important points. One, the model is an open economy model. Basically, that means that there is enough saving to fund a build out in capital and offset and to fund potential government borrowing. The third piece that's important is it assumes that policies are permanent and sustainable. So that we'll probably get into the last 2 points a little bit more, into what assumptions go into these models and why those matter. So for the Trump tax plan, it's a big tax cut, as Ben said. We estimate that it would reduce revenue on a static basis, so we're not accounting for any economic impact, between $5.9 trillion and $4.3 trillion over the next decade. Now, the reason we have two estimates for Trump and just one estimate for Clinton goes back to the pass-through thing. This issue of, do you treat pass-through business income at a special lower rate compared to wage income, is about a $1.5 trillion question. Pass-through businesses have become a huge deal in the United States economy. I think it's about 50% of business profits are earned by pass-through businesses. This means if you cut the rate, it loses a lot of revenue. And our results show this. And going back to Lily's point, when Trump was trying to sort of communicate conflicting messages on this, he wanted to give a tax cut to a certain group while also getting an additional $1.5 trillion in revenue from independent scorers. So we didn't think that the details that he put out were good enough to warrant giving him the $4.3 trillion, so we gave him both. Now, Trump's tax plan reduces marginal tax rates on work, saving, and investment. The reduction in the individual income tax rates reduces the effective marginal tax rate on work. This boosts labor force participation, boosts GDP. Saving and investment also is boosted. The biggest kick in the plan is the cut in the corporate income tax rate. Our model sees that as the most distortive tax of all the capital taxes, reducing that significantly. Yes, it reduces revenue a lot, but it also has a significant impact on long-run GDP. So our estimate, depending on which side of the pass-through issue you fall on, increases the long-run size of GDP between 6.9 and 8.2%. Now, interpreting these numbers, these are level changes, not growth rate changes. So when Trump says that I want to grow the economy by 4% annually, these numbers are nowhere near that. This means that in the future, after the adjustment, so say in about a decade on average, the economy, if we are expecting it to be $100, it's going to be $106.90 or $108.20 instead. So that's really what we're talking about, a level change. Tax policy, in our opinion, doesn't change the long-run growth trajectory of the United States economy. Rather, it changes the level of output. And after that equilibrium is reached, no more. Now, the larger economy broadens the tax base, and this is where the dynamic revenue estimate comes from with that larger base, especially from higher wages. This increases payroll tax and individual income tax revenue against the static score. So the reduction in revenue ends up being $2.6 trillion, between $2.6 trillion and $3.9 trillion over the decade on a static basis. Clinton's plan, it is a modest tax increase, at least compared to the large size of the tax cut for Trump. It would increase federal revenues by $1.4 trillion over the next decade. But it would also increase marginal tax rates. These marginal tax rate increases come from the higher tax rates at the top, the surcharge, et cetera, but also especially from the estate tax increase. This is an increase in capital investment. So we also estimate that the plan would reduce the long-run size of GDP by 2.6%, so much smaller impact overall from the Clinton plan. Now, the smaller economy shrinks the tax base. So on a dynamic basis, we see the plan raising $663 billion over the next decade. The distributional impact. This is that mirror image that Ben was talking about the distributional impact. Here is a graph of our distributional tables. This is measures the percent change in after-tax income for different income groups. It shows that Trump's plan, in the red, greatly increases the after-tax incomes of those at the top, especially those in the top 1%. If we assume that the pass-through tax cut goes through as he originally promised in 2015, that's an increase of 16% for the top 1%, while those in the bottom and the middle get increases that range from about 0.5% to 1%, whereas Clinton's plan is the mirror image, basically, except for the bottom where she increases after-tax incomes through the child tax credit expansion. The top 1% bears the brunt of these tax increases. Now, some just thoughts on the plan overall. I think one remaining issue, and this is just a function of it's a presidential campaign and we're not doing legislation here, there's really not enough detail to determine the ultimate impact of either of the candidates' proposals. While Clinton has been a lot better at putting forth exactly what she thinks the changes to the tax code should be, there are a few questions out there. She's been talking about business tax reform, and she says it's going to raise enough to expand infrastructure investment. It would be nice to know exactly what that business tax reform would be. One guess is probably deemed repatriation, but we're not entirely sure what it is. And it does matter. A business tax reform that broadens bases and lowers rates would have a significantly different economic impact than just a straight deemed repatriation. And then, of course, on the Trump side, details, of course, the pass-through thing. Neither plan is really tax reform. Ben stated that Clinton's plan increases complexity in the tax code. Most reformers would like to see complexity decreased a little bit. I mean, from my perspective, how many minimum taxes do we really need? We already have the alternative minimum tax, which requires you to calculate your income one way. The normal income tax requires you to calculate your income another way. The 28% cap on itemized deductions, basically another way to think about it, creates a surtax that just taxes basically AGI minus charitable deductions above the 28% bracket. The 4% surtax is a tax, I think it's on AGI specifically, and then the Buffett rule, of course, is another minimum tax to top it all off. Now, you don't have to be too sympathetic for those that are going to be impacted by this, but they're probably going to have to spend more on accountants, and that's a cost to the economy. So we'd rather see less complexity than more. And then Trump's tax plan, not really tax reform either. He cuts marginal rates, and that's usually a good thing, boosts economic output in the long run, but he doesn't make any hard decisions when it comes to base broadeners. He has a slight cap on itemized deductions, but it's really not a very stringent cap. I would like to see something a lot more than that. And on the business side, I think reducing the corporate tax rate is great, but he just goes for a straight rate cut and doesn't really think about how else to restructure the business tax code. In fact, I think reducing the marginal tax rate is good, but it may be secondary to other important changes that you could make to the corporate and business tax code. And then the last point here is putting their tax plans into the context of the rest of their proposals. Now, I think Trump's is the most interesting, is I guess the best way to put it. Now, his economic plan, I guess, isn't really internally consistent. So on his tax side, he's really looking for that tax cut that's going to drive investment into the United States. It requires an open economy where goods can move freely and that capital investment can flow into the United States to get this boost that we estimate. But at the same time, he also wants to reduce trade in a way. He wants to reduce the trade deficit. He wants to reduce the amount of individuals that come in here through immigration. These would tend to slow growth. And focusing on the trade aspect especially, when we look at how his tax plan is going to impact the economy, it's going to increase budget deficits. Now, holding everything constant, these increase in budget deficits will likely require the foreigners to purchase treasuries in order to fund this increase in deficit. Well, it is the flip side of that is that the trade deficit will increase. So while Trump says he wants the trade deficit to sort of shrink, his tax plan actually would do the opposite by greatly increasing the budget deficit of the United States. So you may see that his tax plan grows the economy in the long run, but if you put it into context, that may not be the case overall. That the type of economics he wants outside of the tax world makes this a little less his dream of more jobs and growth probably a little out of reach. And then on Clinton's side, all of her tax increases are paired with spending programs. So if she spends that extra revenue wisely, she can offset some of the reduction in long-run GDP, infrastructure spending especially, or spending on education. So I think it's important to put their tax plans and the economic impact in a broader context.
Thank you so much, Kyle, for the thoughtful comments, and we'll turn to Ben.
Okay, so I wanted to take just a little step back first because Kyle was mainly talking about Tax Foundation's macro model, and I think both of us start with a micro simulation model. So I know a little bit about TPCs. It's based on a very large sample of tax returns, so it can model taxes at a very granular level, household level. And these models, a similar model is used by JCT for the official scores of tax legislation. And so these models are kind of what's been used for a long time. I call them kind of the conventional estimates. Sometimes Kyle called it the static estimate. I know at JCT they hate that term because they do allow for a lot of behavioral responses, as Lily talked about. They're not totally static, but they don't include changes in GDP and unemployment and inflation in macro variables like that, which has been a source of great criticism. So more and more. So just to, these micro simulation models, I think there's kind of like a standard approach. And if you look at our estimates, our conventional estimates, and compare them to the Tax Foundation's static estimates, they're really close. So this is something where we all kind of mostly agree. And some of that might be slightly surprising because there are some things about the Trump plan, like thinking about how many people can change their income to get the pass-through rate that he proposed, that are not kind of standard, but really we came out amazingly close on those kind of initial estimates. So you need to do those initial estimates first. Then what Kyle was talking about was the macro model, that then you estimate things like changes in marginal tax rates using that micro simulation model, the static estimates, and in the change in tax revenue. And then those are inputs to your macro model. So you we both start from a very similar point of the kind of inputs to our macro models, but then we're putting them into different models and we get different answers. So, once again, looking at this from a high level, just as an economist, I think there are a few ways, I can think of a few major ways that tax legislation affects the economy. And one is just by changing after-tax incomes, changing firms' incentive to invest, changes the level of demand in the economy. When you give people a tax cut, they spend some of the money that, it's what's referred to as stimulus legislation. People have that extra money, they spend some, and that tends to increase economic activity. So that's a type of effect that's not in the Tax Foundation model. It's not in the main long-run model, the Penn-Wharton budget model that does our dynamic estimates, but I think it's in the short run, it's important. So that boost from demand to the economy tends to be short-lived. In the long run, economic output will be at potential, as Kyle said, depends on the labor supply, the level of capital in the economy. But in the short run, the economy can fluctuate around that potential level. And that in the short run, those effects can be reasonably large. So I'm going to go through kind of an extra model that just really briefly, that kind of takes account of those effects. But we haven't put those together at TPC. And so it's kind of just like a thought piece, like this is a little extra effect that might be missing from the other estimates. Second, changes of marginal tax rates. Kyle talked about lower marginal tax rate on labor income encourages people to work. Lower marginal tax rate on capital income encourages people to save and invest. And those are effects that both of our long-run models take into account. And then lastly, tax plans could change the level of deficits. And I think that, so there's a long-standing kind of thread in macroeconomics that when deficits are higher, that's competing with private investment for dollars. So people have money to invest. If they're investing it in government bonds, then that money's not flowing through to the private sector to provide money for investment. So the way that wouldn't happen is if foreigners are buying all the bonds, essentially. If foreign capital will flow in to cover the deficit, then you don't get a cut of investment. But, or alternatively, you might assume that it could be that private saving would rise to offset the deficits. This is another some economic models would predict that people see that they're going to have to repay these bonds in the future, and they will just save the money to pay it, and that will offset the deficits. I think kind of the mainstream is that deficits do have an effect on output, and that's something that the Penn-Wharton budget model takes into account. The Tax Foundation model, as Kyle said, operates under the assumption that the funds are going to be available to enable firms to invest, to adjust the cost of capital in the model. Okay, so let me talk, so I want to go through quickly what I call our Keynesian model at TPC. This is a model that's only modeling these kind of demand effects. So, these effects are this is really a pretty simple idea. So the Clinton plan on net is subtracting money from the economy. Low-income people get a little bit of a tax cut, but it's much more than offset by higher-income people paying more taxes. So you have lower demand, so these blue bars are negative. We have a modest negative drag on the economy in the short run. And this is attenuated to some extent because we think that high-income households don't spend as much out of a dollar of savings as low-income households would. So that reduces the effect a little bit, but it's in the direction you would think. The Trump plan, on the other hand, increases after-tax incomes by a lot, all across the income distribution, especially at the high end. So you get a boost to the economy from that. You can see in the first year of about a percentage point. And the other thing the Trump plan does is it has the expensing provision that Kyle talked about, would tend to increase investment demand by firms. That's an additional addition to demand. So that's also going into that 1%. So like I said, I do think that this is something that actually happens in the economy. It's not, we haven't kind of integrated it into our long-term modeling. I think it's actually the effect that economists understand the best or are most confident about, at least professional forecasters. This is the kind of effect that people who are selling their economic forecasts on the private market, this is the type of effect, short-run effect that is built into their models. But it's something that we're working on at TPC to kind of integrate better with the rest of our analysis. So I'll leave that behind for now and talk about our long-term model, which is the one that's really comparable to, and I say our long-term model. This model is actually run by my friend Ken Smetters at the Penn Wharton School, and we have cooperated with them. So we have done the micro-simulation estimation and estimated changes in tax rates, basically the inputs to the model, and sent them to him. And he's done the dynamic estimates, the estimates on macro variables. So how does this model work? Well, the Penn Wharton budget model is it's based on simulated households, so that are maximizing their well-being. So they look at what their after-tax wages, after-tax interest rates are, and they try to make themselves as well off as possible in their decisions about how much to save and how much to work. Important things about the model: these households are forward-looking, so they behave as if they're sure about what wages and interest rates and government policies are going to be in the future. So something that Kyle mentioned. So there's no policy uncertainty in this. So when a tax plan is really passed, you don't really think that that's going to be permanent. I mean, Congress changes, the presidents change, and so really every new tax plan is kind of like, well, with some probability, any year, any couple of years, that could be changed in the future. And if you took that kind of uncertainty into account, the estimated effects of these policies would be smaller. But it's very difficult to model that type of policy uncertainty. So our model, and the Penn Wharton budget model in particular, does not have that characteristic. So these simulated households respond to incentives to work and save, so changes in marginal tax rates affect them much the same way as in the tax foundation model. This model has income uncertainty, so the households in this model do face uncertainty, not in policy, but on an individual level, their wages can bounce up and down. And that means that some of their saving is precautionary saving. They're protecting against the times when their wages will go down. And that also tends to make the model less responsive to policy. For example, when interest rates change, that changes the amounts that can have a big effect on the amounts that people are saving for future consumption. But if you're kind of saving as a precaution, that margin doesn't change as much. So it kind of tends to attenuate those responses. It also has a range of income levels. These households are at different income levels, and some of the low income households are essentially liquidity constrained, so they respond, they change their consumption very much in response to changes in income. And these liquidity constrained households, almost by definition, they're not saving or they're not saving much, so changes in interest rates don't affect them very much either. In this model, so Kyle mentioned that their model is essentially equivalent to a small open economy assumption. The Penn Wharton budget model, its base assumption is kind of a blend. So the polar opposite of an open economy where money can flow in freely and the after-tax interest rate is equal to kind of a world rate, is a closed economy model. That would be if the US was an island, all of the investment in the US has to be financed by domestic saving. Neither of those are exactly right. Unfortunately, it's much easier to model those extremes than model something in the middle. So basically what our model does is we do estimates with a full open economy assumption and a closed economy assumption, and then we take a weighted average of the two. And the weights are 40% on the open economy and 60% on the closed economy in the base simulations. What are our estimated effects? Let's see. The Clinton plan, so you can see that these effects change over time, and this has to do with the opposing effects of the changes in marginal tax rates and the changes in the deficit. So the blue bars, Clinton plan reduces output in the short run. That's because of the increases in marginal tax rates. But over time, the deficits are accumulating and the effect on investment is accumulating. The effect of deficit reduction is accumulating. And so in the long run, you get a positive impact on the economy. The Trump plan is just the mirror image. You get a boost to the economy from the lower tax rates in the short run. These big deficits are accumulating, crowding out capital. In the long run, you get negative effects on the economy. And that's reflected in the budget estimates, but because of this kind of time pattern where you're up and then you're down, you can see if you compare the without macro feedback revenue changes to the with macro feedback, they're not all that different. And you know, a lot of that has to do with because this line is crossing, and you don't get large effects, and you don't get nearly as large effects as the tax foundation.
Great, well, thank you for that, Ben. And maybe just one thing to underscore is, as both Kyle and Ben mentioned, the microdynamic estimates are quite similar, both of the revenue effects, but also of those distributional effects that Kyle talked about. So we didn't even bother putting in a second distributional slide for TPC because they were so close.
They're very similar.
But the macro effects, if you looked at sort of, actually, I'll take back the clicker for 1 second. If you looked all the way to the right on this slide, it's the inverse of the tax foundation estimate. So the Clinton plan, rather than reducing growth and revenues from a macroeconomic perspective, is increasing them in the TPC model, and the reverse for Trump from the two have the opposite sign. So maybe Chai-Ching will talk about that or other interesting things about all of this discussion.
Great, thanks. So fun to be here. Really glad to be talking about policy details on a on a cold evening. So on my agenda is really to put these estimates in the context of what is a broader political and economic debate that I'll get to as my first port of call. And the second is to then zoom back into the models and to make a plea for a little bit more information about how some of the parts work. So first to that context point. All of these reports, these tables, these modeling assumptions, these choices are part of really an ongoing economic and political debate about whether and how to take into account macroeconomic effects of tax cuts when you are estimating their cost and distribution. And I just want to relay some of that debate because I think it's really important to evaluating the numbers that are in front of us. So I'm going to start back with the first President Bush and his proposal to cut the capital gains tax rate by 30%. the Bush Treasury estimated that even though you were cutting capital gains tax rates, people would start buying and selling their assets at such an increased rate that revenues would actually go up because of the tax cut. Now, Congress's nonpartisan scorekeeper, the Joint Committee on Taxation, said that yes, the rate of buying and selling assets would go up, but there would still be a big revenue loss over 5 years. So JCT, CBO has continued to take into account these sorts of behaviour changes in their scores. Those are the microdynamic effects that we were talking about before. But what they don't do is take into account those broader macroeconomic impacts, or at least they haven't until recently. So let's jump forward again to the second President Bush and the 2001 and 2003 tax cuts, which were pretty big. The second President Bush and congressional leaders at the time quite often said that these tax cuts, a few $1 trillion over 10 years, would pay for themselves with increased economic growth. Again, conventional JCT cost estimates of those proposals didn't take into account any growth impacts, but JCT and CBO did do supplementary analyses of tax cuts, like the Bush tax cuts, and they found that even under the most optimistic scenarios, the tax cuts' growth impacts would only pay for a slither of the cost. And in fact, under the most pessimistic assumptions, they would actually drag down growth because of the deficit impacts and increase the cost of the proposals. In fact, most mainstream economists didn't claim that the tax cuts would pay for themselves, and later on, the former chair of Bush's CEA, Gregory Mankiw, said that such claims were like snake oil. So let's move forward again to the 2012 presidential election. We've talked about how CBO and JCT don't analyse candidate tax plans. They're nonpartisan congressional scorekeepers, and keeping them insulated from the sort of hot politics that we've seen arise around presidential elections is a pretty smart thing to do, I think. So we look to organisations like the Tax Foundation, TPC, Citizens for Tax Justice for their analyses of what tax cuts are going to do, tax increases are going to do. And in the 2012 cycle, Governor Romney promised 3 things of his tax plan. Number 1, large specific rate cuts. Number 2, that the plan would be revenue neutral, although he didn't specify all the raises that would be needed to do that. And number 3, that middle class people wouldn't see their taxes go up. And TPC issued an analysis showing that with the specific promised rate cuts that he had proposed, that was mathematically impossible. That got quite a lot of attention. Part of the vice presidential candidate Ryan's response to that was, well, these analyses didn't take into account the big growth effects that would offset part of the cost. So now to 2014, a series of House Republican plans promised big specific rate cuts, not filling in the offsetting revenue raises, and also promising no increases in deficits. Into that debate, the then Ways and Means Chairman Camp releases his tax reform proposal, and it's serious and it's detailed, and it includes rate cuts, and it also includes specific revenue raises to pay for those rate cuts. So specific cutting back of industry-specific tax breaks, various other subsidies that run through the tax code. And it kind of lands with a thud. Republican lawmakers don't like the fact that the rate cuts aren't big enough, and seeing specific revenue raises is not particularly popular. It's a hard thing to do. Turns out that the base broadening part of base broadening rate lowering tax reform is really difficult. So on the business side, the Camp plan actually slows down depreciation schedules in order to pay for the corporate rate cut, and that's something to keep in mind. The JCT found that on a conventional basis, the plan would be roughly revenue neutral over 10 years. And to supplement that conventional analysis, they looked at the macroeconomic effects using 2 different models and a whole range of assumptions. So the results, as you can see, blue versus yellow is 2 different models. The rest of them are different assumptions within the models. They vary widely. The smallest bar, in terms of the revenue impact, was more than 14 times smaller than the biggest bar. And this is the one that Chairman Camp chose to cite in his press releases. So JCT and CBO have long been under intense political pressure to incorporate such dynamic estimates into their scores of the cost of tax proposals. And left to their own devices about that, they did not do so. They repeatedly cited that because of the differences in models and assumptions, such impacts are highly uncertain and very difficult to pin down. So instead, they would provide these supplementary analyses using a range of different models and assumptions that lawmakers could look at and factor into their decision making. But that's changed recently, and that was a decision by lawmakers, not by congressional nonpartisan analysts. At the end of 2014 and beginning of 2015, two things happened. First, congressional GOP leaders did not ask CBO chief Doug Elmendorf to return for another term. Dissatisfaction with his failure to implement dynamic scoring was a widely cited reason. And then the House passed a rule that requires JCT and CBO to do dynamic scoring for the official cost estimates of certain tax bills. The House leaders claimed that it would provide more information, but instead of giving a range of models and estimates, now JCT has to provide a single estimate that will be the official score. And the rule effectively allows House leaders to choose when to apply dynamic scoring as it suits them. So JCT and CBO are at the very start of implementing this. They've only issued a handful of scores that use macro estimates under the new regime, but already some conservative commentators have issued pretty harsh criticisms of those scores, saying that they're not big enough and that Congress should intervene if JCT and CBO doesn't alter its approach to show much bigger effects. So now we're finally at this year, and I promise I will tell you why all of this is important to these estimates. Speaker Ryan and the House GOP introduced a Better Way tax plan framework. Now that plan, opposite to Chairman Camp's in a way, moves depreciation schedules towards full expensing. It ramps them up right to full expensing instead of slowing them down. And that happens to be an approach that some macro models, and in particular the tax foundations, generates very big macroeconomic effects that increase growth. And in fact, the tax foundation's dynamic estimate of the Ryan plan showed that that expensing provision alone would pay for about 60% of itself over 10 years through increased economic growth. So that brings us to the candidate plans, and particularly Trump. Some of the change is a little bit relevant here because his first version of the plan was much more expensive and did not have this expensing provision. His second version of the plan scales back some of his tax cuts and adopts the expensing provision that the tax foundation model gives particular macroeconomic growth effects to. So when the Trump campaign cites cost estimates, they tend to cite the tax foundation one that does not take into account the pass-through rate cut and includes the dynamic effects that the tax foundation estimates. So that's a really condensed tour through this scoring debate. And let me summarize what I think are the three important takeaways to evaluating what we have in front of us now. Number one, costly regressive tax cut promises are really easy to make. Rate cut, it's easy to put a particular figure on a rate cut, but it's much harder to come up with the base broadeners to pay for those rate cuts. And that leads plans into math problems. Two, it's lawmakers, not the nonpartisan scorekeepers, who have brought us into this dynamic scoring era in the House. And the House rule itself appears to be geared more towards easing the passage of large tax cuts than providing more information, in my view. And three, dynamic models are highly sensitive to model choices and assumptions. And that also makes them potentially very vulnerable to both cherry picking and manipulation. So all of this, I think, makes it very important that model choices, assumption choices, and limitations are stated very, very clearly when we look at these things. Smart non-economists, like some of yourselves, should be able to look at these models and understand what's driving the large differences between them, and also understand the conditions under which the models might reflect the real world that we live in. So that leads me to the second part of my agenda tonight, and I know we're running a little bit over time, but start throwing the, the signs up when I need to wrap up. But and that's just a plea for even more clarity and more information for anyone that's doing these macroeconomic estimates. The model has put out a really commendable amount of information given the time pressure that they're under, and I'd just like to see that continue to build as we keep moving forward. So let me give a few examples from both the Tax Foundation and TPC models in the spirit of constructive criticism, and I know that some of these things are already in the works from their side of things. So first, the Tax Foundation's model. We've heard that already a key assumption of that model is that no matter how much a tax cut increases the deficit, whether it's a few hundred billion, 5 trillion, 11 trillion, you could ratchet that up to 111 trillion, there's going to be enough investment to fill that demand for resources. And in particular, the assumption is that there's a small open economy model where investment resources will flow in from other countries to fill that gap. So applying that completely small open economy assumption, I think it's fair to say, makes the Tax Foundation model a bit of an outlier, in that many of the other long-run models do try to have some amount of closed economy so that there's not a complete response to fill the hole. And that's an assumption, to be very clear, that the Tax Foundation is very clear about, as we've heard. What's a little less clear is the following. If one thinks that international investors are going to make up some of the shortfall in demand for resources in the economy when there's a big budget deficit, that means that much of the future income produced by the economy will belong to those foreign investors rather than Americans. And the Tax Foundation model currently reports how much tax changes increase the growth in GDP, and that's production in the US economy. Even though in that model, much of that flows out to foreigners. So if international investment is a big driving part of this model, what you would really also want to see is what happens to GNP, which is gross national product, or the income that's owned by American nationals. And at the moment, the Tax Foundation doesn't report that, and in a very thoughtful post in response to some of these comments, they've said that they're, and we can get into this in discussion, said that they're looking at some of these things. So the other example is that the Tax Foundation model, as we've heard, is a comparative statics model. So the model itself, there's no sort of time in the model. It just looks at the state of the economy in the long run once everything has adjusted to a tax change. It doesn't tell you anything about how long the economy will take to get there, or the path of how it takes to get there. So the Tax Foundation, when it does its analyses, separately creates a transition path, and that's what gets you the 10-year budget estimates that we all look at. So if one took different transition path assumptions, or one took those transition path assumptions out altogether, the results could look very different. And in fact, probably you'd be able to see that they're more different than some of the other models that we see that look at just the long run. So again, in a thoughtful response, they've said that they're looking at making those sorts of things more transparent and building their modelling of the transition path. On the Tax Policy Centre and the Penn-Wharton model, the one that looks at sort of more the long run effects, I'd also love to see a little bit more about the choices and assumptions. There's a really nice, I think you mentioned that there's a tool online where you can actually go and change some of the assumptions in this model and see what it does, which is a really great tool to sort of learn the extent to which these things matter. For example, it lets you toggle how much the economy is open. But again, if you make the economy more open, the difference between what is made in America and what Americans own becomes more important. And again, the Penn-Wharton model only reports GDP and not GNP, so I would love to see that additional measure of growth be reported. There are also some features of the model that can't be changed, and they sound really cool, but it's actually really hard to tell how much they matter. So one example is that we've talked about how that sort of model requires to even run that there's an assumption that debt stabilizes over the long run as a share of GDP. The model simply won't give you an answer if you have debt on an unsustainable path. So they've got to put into the model, if the policy is for large tax cuts, they've got to put into the model some offsetting policy at some time in the future that stabilizes debt. And what the Wharton model does to try to minimize the effect of that assumption, which is not part of the tax plan that's being assessed, is to start those offsetting factors happening in 2040 rather than in the budget window. But again, it's kind of hard to tell how much it matters to start it in 2040 versus 2030 versus 2020, to assume spending cuts in the end versus tax increases, all sorts of things like that. And I'd just love to be able to know a little bit more about that. Another sort of thing that's new and cool about the Penn-Wharton model is that instead of taking some representative agents from the micro-simulation models that you've heard about and running the macroeconomic estimates, it actually sort of tries to run the macroeconomic estimates on each and every actor in the micro-simulation model. So it's sort of like running these simulations for every single tax filer in their model. And again, that sounds cool, but it's kind of difficult to tell how much that really matters in the end from the results, at least from what I've seen being reported. So finally, I'm really looking forward to TPC rolling out its solo type model, which is one we haven't talked about a lot tonight from their results. That's actually the model that JCT and CBO tends to use most often, and it's the sort of model that the Congressional Research Service actually says most often matches empirical estimates of what tax changes do to growth. So that's the model I'm particularly interested in seeing them add to their suite of models. So that's I think the context that I think we're sitting in, and that's why I'd love to just see more and more information, although it seems like I'm being greedy given all the great stuff that these analysts put out already.
Great. Well, thank you all for really enlightening presentations, and I want to make sure we now have about 20 minutes of time for questions. But maybe before we do, Chai-Ching, I think, has sort of posed some questions, so maybe I'll give both Kyle and Ben an opportunity to react to those, and then open it up for whatever questions you have. And I should emphasize, your questions do not have to be about the models. You can just, say, what do you love and hate about these tax plans? Or it could be about the substance of the plan. So, but first I'll turn it over to you guys.
Yeah, so I guess it'd be useful to just talk about what I think are the three biggest assumptions that I think go into the Tax Foundation's model that if you rank them are the biggest move our results a lot more or a lot farther from, say, TPC's results. So the first one is the open economy assumption, the issue of capital flows. Now, this is probably the boring one, but I think it's the most important one, is how much saving is available to the United States. Now, traditionally, a lot of people say that, yes, the U.S. economy is open, but not perfectly open, in that there's that when the U.S., the federal government borrows, there is some crowd-out effect. And empirically, you can find papers that show this, and I think CBO, JCT they do a really good job of tracking with these empirical estimates. But in the last few years, 5, 6, maybe 8 years, the question, this issue has sort of fallen to the wayside, and now people are more interested in understanding more of why aren't interest rates rising. The U.S. federal deficit is going up. It's projected to go up, but interest rates continue to decline. And people such Ben Bernanke, for example, has hypothesized this global savings glut, that maybe there is just a lot of saving out there that is available. So maybe this crowd-out effect is declining as time goes on, and it's something that we should re-examine. I don't think, personally, I don't think the issue of the crowd out is a fundamentally flawed assumption. We just don't model it because we don't think it is a very large issue. Now the second piece, or I can just fold the two last ones into one, where the baseline parameters. What do you think the baseline tax system looks like? This sounds like a really simple issue of just like looking at the tax code, but it's actually a little complicated when you start paying attention to how these, how marginal tax rates change. I'll take a really good example, which is something that we're examining now, is the estate tax. Now, theoretically, the estate tax is if it were levied evenly, is a pretty broad tax on capital in the United States. Some capital is insensitive to taxation, land, for example, but other capital is very sensitive to taxation, productive capital, ownership of stock in companies. Now, that's the theoretical estate tax. But how do you model a tax that is a really leaky bucket, right? Estate tax, people plan around the estate tax all the time. The estate tax, when you check Fortune 500, or not Fortune 500, but the Forbes 100 or 500 richest people and their assets, and then compare to say what they may have to pay in the estate tax. I think the JCT has done estimates on this. The difference between what they estimate their estates are worth and what the IRS finally gets their hands on, huge difference. So how do you account for that sort of leaky bucket? In modeling that matters. So if the estate tax under the baseline is this small and then you eliminate it, well, maybe the estate tax doesn't actually matter all that much under current law. So it's how close is the tax system to a perfect consumption-based tax, and that matters. And then just responding to the two issues, and I've written all these down before, but the question of who gets the income later does matter. One point is we do estimate wage growth, so that is earned by individuals in the United States. But who earns the capital income? That's a big question. Our team right now is working on an expansion of our model to what economists call a general equilibrium model, where we are looking at the saving behavior and investment behavior of individuals in the United States and also foreign financial flows. So we can actually start looking at that and separating that. And I think it is important. So.
Great. And Ben, maybe if you could just do 1 minute so we can do some Q&A.
Yeah, so I'll try to be really quick. Yeah. First, you talked about transparency, and just the Tax Foundation gets huge points. They're very transparent. They've published how their model works. We are not there. We're kind of in the rollout phase of getting our models to work. We need to do a better job in being as transparent as they are. Deficits, do they matter or not? I'm going to just point out one drawback to our approach, which is when deficits really matter, then it really matters that you're not looking at the president's plans as a whole, that you're only looking at the tax plan. So we gave Clinton's plan a whole lot of credit for reducing the deficit because her tax plan does, but she really plans to spend that money. So it puts you in a little bit of a bind. I think if you think that deficits matter, that it's a bind you kind of have to be in, but it does cause problems. We also did not report GNP. It's in the model, so we just need to report it, and that's actually something we've discussed. Right. I think, the tax base is mostly GDP. It's mostly domestic production, so that's kind of why these models where you're estimating revenue, that's the reason that we concentrate on GDP, but it's not most relevant for kind of domestic welfare.
Great questions. Michael.
Yeah, and this whole discussion of the dynamic scoring seems to skew the whole discussion in favor of tax cuts instead of increased spending. Because if the government wants to spend $100 on tax cuts, you pretend it's only going to cost 80 because of dynamic scoring, or if they spend $100 on infrastructure, even though that might increase the economy and increase revenues also, you treat that as $100 expense, even though they might end up the same in both cases. So it seems very skewed just to focus on the dynamic scoring for tax cuts instead of spending also.
So if I could take a stab at that, because you also mentioned Doug Elmendorf. So what Doug would say, Doug really worked hard to improve the CBO's modeling. And what he would say is, just because something's uncertain, you don't want to assume it's zero. So if we think that tax cuts are going to have some effect on incentives and are going to affect the economy, we're better off including that than not including it, even if it's very uncertain, and we just need to make our best guess. Now at CBO, we actually do give credit for infrastructure investment and things like that, education. So in CBO estimates, that was included. Our estimates were that the problems with that is that spending takes a long time to if you appropriate money, it takes time to spend out. It takes time for it to become productive, especially something like early childhood education. You might be waiting 15, 20 years before you see a return from that. So we didn't find huge effects, but we did include them. So this bias, I mean, to the extent there's a bias, it's because our best guess is that changes in taxes affect the economy.
Yeah, I'll only add that I think modeling spending is also important. That I don't think that we should only focus on the economic impact of tax policy. I think the economic impact of spending policy is equally as important.
So one thing, the House rule, even though CBO does take into account for some of its analyses the impact of spending on the economy, the House rule doesn't allow it. But
That's if they just like tax cuts.
so there's it's not entirely that. So one of the problems with the spending side is a lot of it takes time to accumulate its effect on the economy, and even if you took it into account, education, early, pre-K, all these things that you might think matter for human capital accumulation, it's going to be outside the budget window before it shows up. Another big problem is that a lot of spending goes through the appropriations process, which only puts it in law for 1 or 2 years at a time. So you're only looking at these very small chunks of spending that you can't assume go out for a very long time. And the third problem is you don't know necessarily once something is given outlay authority or a chunk of money to a department to spend, what particular projects that's going to go to. So it makes it very hard for the estimators to know what's going on. So it's not necessarily, I don't think, the case that you can fix dynamic scoring by just adding it to the spending side, although I would absolutely urge policymakers to take into account those potential effects. The other thing, I think I've sort of heard this a few times, that you're sort of, if you know that tax changes have an effect on the economy, then you should just include them anyway, even if the effect is really, really uncertain, because otherwise you're biasing your estimate towards zero, and you know that the effect is not zero. And I think that's the case. The problem is, though, that in a lot of cases, as previous JCT and CBO analyses have shown, we don't know what side of zero the effect is. So we, just by sort of adding an estimate doesn't even necessarily mean you're pushing your estimate in the right direction, let alone knowing what magnitude you should be putting in there. So I think that's part of the reason why sort of the push for the need for the models to be really clear about what they're doing is so great, because there's the potential, if you chose a different one, the effect would not only be a different size, but go in a different direction.
Christine. So I have a question on Trump's tax plan on pass-through taxation. So one version of pass-through tax is that an entity should retain profits to get the special tax 10%, and then once the candidate distributes that profits to partners, then it's subject to dividends taxation. So I have a question on the dividend taxation part, because is that like, since the entity should retain profits, the distribution would be universally treated, characterized as dividends? Is that what you're referring to? Or most of the income, flows through, so it means they retain the original character, but the most of the income flowing through is dividends. So what is the correct interpretation of that?
I don't know the correct interpretation of the dividend treatment, but usually when people ask this, I just say think of it more like the pass-through for tax treatment needs to look more like a traditional C corporation.
It sounds
Yes, and I think that that's how they were trying to thread this needle and say that we're going to give a tax cut to all you businesses, but we're not going to lose trillions in revenue. But the TPC's analysis shows that even if you assume this odd middle ground, it still loses a bunch of revenue.
I think it's also fair to say there's been so little put out on this issue that I've had email exchanges with people where we've come up with 6 different hypotheses of what it really means, and all of them are consistent with what's put out, so it's just unclear.
Yeah, so I'm trying to understand, maybe this is clear what you said, but you have a change in the tax, in the prospective change in the treatment of foreign source income when you have a deemed repatriation, and that's like a big number on that. How do you think of that in terms, is that sort of as like a one-time, so it's a one-time thing, there's no forward-going effect in incentives, is that?
That's correct. That we look at at least deemed repatriation. We look at as a retroactive tax in a way, and retroactive taxation does not have impact on forward-looking investment. A holiday, on the other hand, that actually may have behavioral issues. I think it's reasonable to assume that businesses will react to a holiday by assuming that there will be another holiday. But usually the deemed repatriation is paired with a transition to a new system. We're not really sure if Trump is going to transition to any system. There was an article yesterday in Bloomberg B&A talking about this issue, that the original plan, September 2015 plan, eliminated deferral. So you'd be taxed on a current basis on your foreign profits. Well, the new plan is quiet on that issue, that we don't really know now whether we're going to keep the same system, and that this deemed repatriation is just, for lack of a better term, free money.
Yes.
Yeah. So my question was relating to the potential planning opportunities that are going to arise, especially with the tax increase. What kind of weight do the models give to the inevitable tax planning that's going to try to circumvent some of these changes?
So I think a lot of that happens on the micro simulation side. So that's one of the types of responses that the micro simulation models incorporate. So when tax rates rise, there's going to be more tax avoidance. People might look for deductions more. So taxable income goes down. There may be more tax evasion. That's the kind of behavior that you can include in those models, and they do take account of it.
Yeah, and my discussion of the estate tax issue plays into that, because that actually impacts what your marginal tax rate may be at the end, and how much of the capital stock is actually subject to this tax that theoretically is a pretty big tax.
Dan, can I say one thing about the estate tax, because that reminded me? I mean, there is a question whether the estate tax even is a capital tax. It really depends on how you think people feel about estates, and whether there's a bequest motive for saving. Are people saving because they want to leave a bequest, or do they happen to have a lot of wealth? We know that people try to avoid the taxes, so they would rather have the money go to their heirs than the government. But does it really influence behavior? It's a different type of tax, I think, and so it's not obvious that it's a tax on capital in the same way that other capital taxes are.
Right, we had a question in the back.
Me? So as someone who is not an economist, what would be your biggest takeaway from either the tax plans as a whole or each separate candidate's tax platforms?
So to me, the biggest takeaway from the tax plans actually doesn't have to do with the macroeconomics. It's different visions of what you want government to do. One tax plan is raising the revenue that is generated so that the government can provide more services. The other plan is cutting revenues and probably cutting services. So kind of, do you want to be in this world with a lower tax burden and smaller government, or a bigger tax burden and a bigger government? And then number two, the distribution. Who do you want to pay? Do you want more of the burden to be on high income or less of the burden? Those are, to me, the biggest differences between the plans.
Yeah, mine goes out a little bit or away from economics in general, and more towards just the vision of these plans. Just generally, Clinton's plan is more well thought out. She matches her tax increases with spending policies that she thinks are important. Some of her revenue raisers are pretty efficient economically. Her cap on itemized deductions is actually a pretty reasonable policy, and that could be incorporated into a broader tax reform. Trump's plan, I think, again, I said it's just a tax cut. He's not really trying to reform the code. He has a couple things in there where he's like, well, maybe I kind of want to flirt with tax reform, but maybe not. This odd policy of allowing manufacturers to choose between interest deductibility and expensing. If you were really interested in reforming the corporate tax base, maybe you would just say, like the GOP plan does, well, we're going to get rid of interest deductions and go to full expensing. So I think it's beyond just the vision of what the government should look like or what the fiscal system should look like. It's just whether these plans are well thought out or not.
It's two different questions. First of all, where is money creation in all this? Because you seem to be talking like we're dealing with a finite set of dollars, and we have to go get more of them that we issue to Arabs for oil and drag them back to pay for stuff. And apropos of the pay for, are you kind of prisoners of congressional budget rules too? Because you're taking revenues and pay-fors according to a little narrow set of rules that doesn't accurately measure stuff, and we know that there's Fed spending and military spending that's essentially monetized. So, I guess where I'm going with all this is where are you getting, deficits crowding out or even deficits matter if at the same time all this is going on, the money supply is increasing. We don't measure it anymore, because we stopped because we couldn't, but, we're creating money, so, I think this kind of, you sort of have a static thing going on there with that, too. And a House budget rule bound kind of mindset on that.
So I guess these are real models, so there's no money supply really, and that doesn't enter into the models. I think we know that changes in monetary policy can have big effects in the short run, can definitely impact the economy. I think these models operate on the assumption that in the long run, those will only change prices, and that the real economy is going to be governed by kind of these underlying incentives.
And maybe I will ask one final question, which is not that we need to think of JCT and CBO as the oracle of the truth, but do you have any sense of which of these models comes closest to what they might estimate?
I think the TPC model probably comes closer to what JCT and CBO would think about this stuff. In their model, a crowd out is a big factor, and we do not model that effect.
I think I agree, but I'd add one more thing, which is that one of the reasons all these microsimulation models tend to come up with similar answers is because they were designed to get the same answer as JCT. They were basically trying to copy JCT because that was, they were trying to predict what the JCT score would be. And it could be that as these dynamic scores become more common, that there will be a little bit more of a consensus about how the macro models should be, once again kind of led by these nonpartisan government agencies that would kind of create the precedent.
Great. Well, I want to thank our panelists so much for coming today and sharing